I hereby introduce to you Mr. Michael Veazey.
Starting a business on your own can be lonely and worrying. Selling online multiplies this issue tenfold. Getting expert help is a great way to reduce anxiety, wasted time, and confusion. The Amazing FBA mentoring program is in its 4th year of helping sellers to get started on Amazon. By now, we have former clients who have, starting from scratch, done 6 figures and even in one case 7 figures a year. Obviously, these are not typical results. These are exceptional people. Nevertheless, we can help you get launched faster, safer, and with a much higher chance overall of success. With clients from Melbourne, Australia to Manchester, England, we bring a genuinely international perspective. To find out more, go to amazingfba.com/mentoring. Thanks for listening. Ladles and jelly spoons, welcome to Amazing FBA. This is your host, Michael Veazey. Today, in our series of misleading metrics, i.e. numbers that people are measuring on Amazon that they think are important, but I believe may be misleading them, we're going to talk about revenue and why revenue is not actually an important number in the ways you think it is. So let's start with one of the most important sayings in business. Turnover is vanity, profit is sanity, cash is king. I really believe this to be true in all businesses, but I especially think this is true in Amazon. So let's explore exactly why that is. So these are 5 reasons why Amazon revenue doesn't matter the way you think it is. Here they are all together, and then we'll explore each one in detail. First of all, revenue is not cash flow. Second one, you can't live off revenue. Kind of obvious, but we'll explore that. Number 3, it doesn't make it a lendable business. Let's look into that if you want to get a loan. Number 4, it doesn't add value to the business if you ever want to sell it. And number 5, it's not a true top line. This is a bit more of a sophisticated concept, but for those of you who are already in business with a substantial turnover, it's going to be a very important one. We'll talk about that in another episode as well. So the first point, revenue is not cash flow. As the saying implies, cash is king. This is doubly true with a capital intensive business like property, and it's true with e-commerce if you buy the products before you sell them, whether that's retail arbitrage or any other form of business where you spend the money first and you get paid later. But it's triply important if, like with a private label model, you have to sink a lot of capital into part of the business, that is any given product lines, and hold it there for quite a while. So if you have a 1-month manufacturing lead time and 2 months for freight, it's a 3-month lead time. The very, very shortest time for any of your products that you're going to be holding money there is 3 months if you're assuming that you pay all the money up front. Now, that may not be true. You may have a deal with your supplier. There are various kinds of deals. I mean, the most common one you can get out of the gate is you put 30% deposit down, 70% balance paid when they've made the goods. Sometimes you can get even better deals than that. But the point is, that's really the metric that I would be keeping an eye on like a hawk, is cash flow. And we'll talk about cash flow as a separate topic, which is neglected metrics, which is another area that I want to talk about. So if your business throws off a lot of cash, then you can do all sorts of things, but you can grow organically in an easy way. And that's not the same as even profit, which we'll also talk about, but it certainly is not the same as revenue. Okay. Number 2, you cannot live off revenue. Kind of obvious, but people forget this every single time. I get people with jobs that make them $100,000, $150,000 a year, who therefore I would assume presumably at some level pretty bright and employable people. But it's quite amazing to me how they come to me for mentoring and they just completely muddle up revenue with profit and with cash flow. And I think the revenue of your business and your personal income from it are very, very different things. And if you have only ever been an employee or freelancer doing a service-based offering, then you're just not used to how violent that difference is. So this is something that sounds like the bleeding obvious if you've ever run a business, but I promise you faithfully, these are all based on experience of what people say to me and what I have to say back to them to sort of give them a reality check. So first of all, you shouldn't be taking any money out until you've grown a business to the point where it can afford to pay you as owner director of the business. That's the first thing. Again, it sounds to any business-like person like an obvious thing, but if you're new to the game, I guess it's forgivable to overlook that. People try and create a business as a sort of duplicate of their day job, and that makes sense. I guess people do what they used to, but if you think clear-mindedly about it for a second, if you start taking money out of your Amazon business, almost immediately, you've just created yourself an alternative, rather unstable job. You're not leaving money in there to grow a passive asset, which will produce passive income. And passive is not the right word, but I do know, for example, a member of the 10K Collective Mastermind was saying the other day how he works on this business about 3 hours a day and is doing about £1.2 million a year or something like that. So in terms of profit and what he takes home, obviously it's going to be a fraction of that, but that's where you want to end up. So if you start taking money out early, then you really are looking at it incorrectly. And again, I say this for the people who haven't yet started a business. If you've got a business already, this may be becoming obvious to you. But that's the second thing. At some point, though, if you, assuming you're not planning to sell soon, at some point you do need to justify to yourself and your loved ones the time, energy, and money invested in your Amazon business. So you can't just keep bringing no money in and spending all your time on it. Now, the time that it takes to get to the point where you start to take money out for yourself, maybe it's 2-3 years down the line. 3 years seems to be a typical number. That may be part-time. You may keep other work on, or you may find an alternative income stream. You might have some property. You might do some consultancy work within the Amazon space. But here's the basic thing. It sounds blindingly obvious, but people overlook it all the time. You cannot pay yourself dividends as the owner except out of profits. And the other way of taking money out of the business is as a director. So if you take a salary instead as a director, there has to be enough money left in the business after the other expenses to pay that salary. Either way, you effectively pay yourself out of the profits, right? There's a technical distinction, but I personally think that you should be paying yourself a salary that is a market salary. So if you're running $1 million a year business, that's actually, in terms of a CEO position, a part-time position, because it's not normally considered that you'd need to be working full-time to manage a business of that size. Now, if you're growing it, you might be working incredibly long hours, but to just manage it, that's the director's job, and a director's salary for that might be, I don't know, $50,000 a year or something. So if your business can't pay you after, say, 3 years in building the business, $50,000 plus make a profit that you put back in, there's something wrong with your business. And the revenue really has no effect on that. I mean, you could end up with a business that does $200,000 a year, and it's massively profitable. It could pay you personally $50,000 a year quite easily. But as we'll see with an e-commerce business, that's not normally how it works. Number 3, it doesn't make the business lendable. So what does that mean? Well, if you want to get a loan, the key is cash flow. So if a bank is lending you money for a mortgage, which most of us have experienced at some point, as an individual person rather than a company, then it's based on your cash flow. You may feel like it's based on your salary, but that's kind of an artificial thing. Really, what it comes down to is your ability to keep paying money each month to pay the interest on the loan, and assuming it's a repayment loan as well, to pay the capital down over time as well. Same in e-commerce, but this applies then to your business. So the cash flow is key. It is not about the revenue. So with a capital intensive business, by the way, are you going to need to worry about this? Yes, I think for most people you are. With a capital intensive business, there are key points, particularly if you've got a very seasonal product, and most products on Amazon are seasonal, by the way, like Christmas or the holiday season or Q4, whatever you're going to call it. Even a modestly sized business might require some extra funding just to tide them over the massive need for extra stock, which you're probably going to order in maybe August or September typically to get in for November. Maybe even earlier than that. So that period is when you're going to need to get quite a lot of extra funding. It tends to be around September, October, when cash flow is at its most squeezed. So institutions from Amazon lending, which often will make offers quite early and easily to Amazon sellers, through to Funding Circle, even banks, who are harder to convince, will often be willing to lend good money, but only if your business is cash flow positive. And if you're not keeping good books and really on the case with the difference between revenue and profit, gross profit and pre-tax profit versus cash flow, and all those other things, if you're looking at bank lending, they really need to know that you understand this stuff, and rightly so, because why should they lend money to somebody who's driving blind financially? So this is kind of a function of revenue, but only if it's profitable and if you don't overtrade. In other words, if you sell a load of stuff and you then have to go and spend a ton of money on inventory to fulfill those sales, you could end up trading broke, growing broke, as it's called. But with Amazon, we mostly put the money down up front. So that's less likely to happen. But in the end, profit is critical, but cash flow is the most critical of all, because that's the basis of lending. Reason number 4, it doesn't add to the value of the business. Revenue does not add to the value of the business. When a privately held company, that is one that's not in the stock market, when that is bought, is generally valued as a multiple of the profit. Specifically, is the pre-tax profit plus the owner discretionary earnings. Remember, we talked about you being able to pay yourself some kind of salary and retain profit in the business. Well, this is when it starts to show up. Revenue has almost nothing to do with the sellable value of the business. I mean, it could be a part of the idea of how big the business is, but when it comes to selling a business, the number that people bang around isn't revenue, it is the asset value. So if you call something $1 million business, quite normally amongst Amazon sellers, we're talking about $1 million a year revenue. But when you're talking about a business in a selling context, a $5 million business means it's valued at $5 million. Typically, Amazon private label businesses can sell for 2 to 3 times annual income, annual profit, I should say. And that would be, so it's a $5 million business. If it's twice annual income, you'd be looking at 2.5 million, I should say, annual profit, which maybe if you've got a 10% profit margin means you're doing $25 million in revenue. If you've got a 20% margin, it means you're doing somewhat less. What about 12.5 million in revenue? Sorry, I should be trying to say 1,000 here because my brain won't compute all the millions, but that's a very different proposition. So the revenue versus the value of a business, very, very different things. Reason number 5 is a more subtle one. I'm going to go into this in more detail in a separate podcast because I think it's worth really digging into for those who understand their finances. But the simple version, revenue is not a true top line. Now, this is based on Greg Crabtree's book, which is, I always forget how to say it because the title is so complicated. Simple Numbers, Big Talk, Straight Talk, Big Profits. I think that's how it is. I'll put a link in the show notes, which are at amazingfba.com/blog. But broadly speaking, Amazon or e-commerce for most business owners or entrepreneurs does not exist in isolation. Most people have either a day job, they may have a property portfolio, and they may have an existing business. Those are common situations that I come across with most people. So when you're trying to compare different businesses or different investments with different business models, you need to be very careful which top line or metric you choose. So in e-commerce, a lot of your revenue numbers are really what we would call pass-through costs, or what Greg Crabtree calls pass-through costs. For example, Amazon gets paid for you from your revenue for their sales commission and fulfillment costs, but they only get paid when you make a sale. So that means you never really even touch that money. But even if it came to your bank account, if it just kind of whizzes through your bank account and goes straight back out again, you can't make use of it really. So that is what's called a pass-through cost. And if you sell a $10 widget, it may be that about $3 or $4, so about 40% of that revenue is actually Amazon pass-through costs, the sales commission and the fulfillment costs. We never get to see that. If you think about it, the mechanics of the Amazon payments when we receive an Amazon payout every 2 weeks shows this very clearly, because what we get, we see the revenue figures on the dashboard, but what we actually receive in cash is the revenue minus the net cost of Amazon costs, including sales, fulfillment costs, and other costs as well. Now, you could argue about this with your accountant, and it is something you should discuss with your accountant. I should have said up front that in the end, this stuff is a starting point for discussion with your accountant, not an end point, because I am not an accountant, and I'm not going to take responsibility for you going away and taking action on anything that I've said today and turning around and blaming me for something bad with your business. On the contrary, these are big picture statements that are not so much immediately actionable as they make you pause and think about what you're measuring in the first place rather than actions, right? So what I'm implying with all of these misleading measurements, misleading metrics episodes is to say to you, go away and rethink how you're approaching this. Think about what you're measuring and decide what you're going to measure very carefully. As in all these things, particularly to do with finances, you really, really should go and talk to your accountant. Greg Crabtree is an accountant. He's a CPA, as they call it in the States, who specializes in accounting to help really small and medium businesses for these distinctions. I cannot recommend it highly enough. I really, really, really think that I'm not an accountant. I'm not a specialist. I'm not necessarily always interested in the minutiae of accounting. At least I struggle to be, but you cannot avoid it at the basic level as an absolutely must-have skill set for any entrepreneur. And Greg Crabtree's book, I've got it here. It's Simple Numbers, Straight Talk, Big Profits. Very, very good. I've got a link to it in the show notes. So The simple version that Greg Crabtree gives is a simple rule of thumb is that if your gross profit's under 40%, you should use gross profit as a top line rather than revenue. So viewed through that prism, a $10 million a year Amazon business, so that's got a revenue of $10 million at 30% gross margin would be in fact seen as a $3 million a year business. And that can be very important when you're comparing it to other business opportunities such as property, or where you might have pass-through costs like your mortgage, or a consultancy where you may not have many pass-through costs. So your revenue in a consultancy business may be more accurately actually a good top line to have. Now, I'm not going to get into it in more detail here. If you really want to know about it, go read the book. But if you want the quick version of my understanding of it in an e-commerce context, which Crabtree is not a specialist in, then listen for the next podcast episode, and we will talk about the difference between revenue and gross profit and why you may wish to consider gross profit as your top line rather than gross revenue. Once again, I just want to emphasize, in the end, as my business coach Jason Miles said a while ago, and many other people over the years, none of us as entrepreneurs really spend enough time talking to our accountants. Talking to lawyers is one of those things where you need to pick your fights, because they tend to be a bit risk averse and they tend to be perfectionist. Sometimes a lawyer is a very important investment, more to protect yourself than to necessarily do things. I think when an accountant, if they're really good at explaining things, so more of a financial consultant as well as an accountant, and they don't always exist in the same person. But if they're not just a bookkeeper and they're not just doing your taxes for you and you just say, yeah, go and do it and get it done and hand me the paperwork to sign when you've done it. Instead of that, if you talk to them and thrash these things out and think about what metrics to measure, what the meaning of those metrics is, and also keep in touch with them to measure, okay, once you've got the right metrics in place, how are we doing on those metrics and what do you interpret that means? Then you're going to have a much stronger, more professional business. And once again, that makes it much more lendable. The banks will be way happier to lend to you if you have good books. And in fact, if you have lousy books, or you show as a business overall a bad understanding of finance, you won't get the loan. And that could be the biggest barrier between you and growth. And when it comes to selling it, again, people really want to see clean books. So that sounds like a superficial reason to talk to an accountant. But what I'm talking about is a way more fundamental thing, which is if you measure the wrong metrics, however diligent your measurements are, you will never get great guidance because you're looking in the wrong direction. So instead of which, if you know which ones are misleading metrics, we're going to talk about the neglected metrics as well. And once we talk about those, I think that's going to really, really help you to clarify the sorts of start of the conversation you have with your accountant. Once again, I am not an accountant. This is a great starting point for a discussion with an accountant so that you can come to an in-house decision on which metrics you think are critical, which ones you're going to measure obsessively, which ones you think are somewhat important, and which ones, frankly, you may measure, but you understand that they don't mean that much. And I would absolutely argue that, sadly, for our egos, revenue is one of those metrics. So what to do about all of this stuff with misleading metrics knocking around? Well, here's the first thing. Talk to your accountant. None of us generally talk to our accountants as often as we should. That's what Jason Miles of Winning on Shopify said to me when he was working with me as my business coach. And so important not to just use your accountant at tax time, whether that be corporation tax or personal income tax, nor to just use them as bookkeepers to take away a fiddly task that we don't like. I mean, of course, that's not a bad use of delegation, but that doesn't go far enough with finances. Tony Robbins says, delegate, don't abdicate. And I think that we're all guilty of this, but financial measures are just too important to delegate the responsibility for. In the end, as entrepreneurs, we are responsible for the survival or crashing of our business, and finances are at the heart of that, particularly cash flow. Instead of which, I think we need to make our financials key advisors, absolutely the center of our business. It's no coincidence that one of the fastest scaling mastermind member businesses has a fantastic finance director, or FD, which is a CFO, chief financial officer, by the way, in American terms, right at the center of their business. He's full-time and he only works for them, and he's formerly of some very prestigious companies. And I think that's one of the reasons why they've done so well over the last couple of years. They've been the mastermind. They've doubled revenue twice and heading for 8 figures in this year. So some of the things you should be thinking about going over with your accountant as a substitute financial director for you should be setting financial goals, which may include revenue goals, but more important, profit goals, cash flow, cash planning, cash management, deciding what to measure in progress towards that. That's really what we're talking about in this series. Monthly or weekly check-ins on your business's financial health and goal progress. These are the sorts of things that should be the lifeblood of your business, and really the sort of thing that an accountant is really going to help you with. The second thing I would say is, less critically than an accountant, but if you're just starting out, or if you're part of a mastermind, if you're confused by all the metrics flying around, you want an entrepreneur's point of view, which is a bit different from an accountant's, you're best off referring to your mastermind of peers if you have one. If you don't yet have a serious peer group, that is ones with substantial e-commerce revenue, then you may wish to consider getting input from a business mentor, an Amazon consultant, or an Amazon coach, whatever word you put on it. It's the same kind of thing. If that's something that you think I can help you with, I do offer a specific service now where we focus on what to measure, how to get those figures, and how to make sense of them. That includes marketing and financial figures with a focus on Seller Central and Amazon specific metrics, which is where, of course, I have perhaps more specialism than an accountant who might be able to help with more general business metrics. So if you want to find out more about that, go to amazingfba.com/measure, and you can find out more and book in a session. It's a one-off session, so you don't have to commit your life to anything. It's not particularly expensive. And I try and boil things down to keep it pretty simple as well. So if you're just starting out and you don't have a mastermind to refer to, then that could be a really fantastic use of your time. But whichever way you tackle this, just be very, very careful what you choose to measure, because the final thing to say is it's a bit of a catastrophe to spend a lot of time and energy and potentially money, if you've got a bookkeeper, measuring a metric that just doesn't really matter. So think about what you measure, and what you measure is where your focus goes. And remember, the quality of your questions determines the quality of your focus, and the focus determines the outcomes you get. The quality of your questions, as Tony Robbins said, determines the quality of your life. Don't forget that importance. The questions we ask point us in a certain direction. Thank you very much for listening. Have a great evening or morning.